Hello, my name is Przemysław Kwiecień, I'm Chief Economist of XTB, and it's my pleasure to welcome you to our weekly trading webinar. So today we are going to discuss rampant inflation. In the US, the inflation rate is at 7%, which is the highest since June 1982, which means nearly 40 years. And what does it mean on the market? This will be our focus today. So yeah, as you can see on this chart, inflation is not only the highest since 1982, but actually it hasn't been rising like this since beginning of 70s. So it's the only pretty much there were only two situations where inflation was rising, post-war situation when inflation was like this. One and both of them were in 70s. One of them was at the beginning of 70s. The other rampant increase in inflation was in the second half of 70s, but from a much higher level. But from a low level, we actually only have one situation in the whole post-war history of the US when we saw inflation surging like it is today. So the question is, of course, is it a reason for concern? Because as you can see here on the bottom of this slide, the differences from the market perspective are enormous. Back in 1982, when inflation rate was last at 7%, 10-year bond yield was at 14%. Today it's 1.70. When 1.79 today, as of writing this, it was 1.73. Well, it's not a huge difference. The huge difference is between 1.7, 1.8 and 14%. As you can imagine, the Treasury would be in a real trouble with bond yields at 14%. So obviously from the bond market perspective, I will see that actually it will be important for the whole market in few slides time. This is a huge difference. Another huge difference is in valuations. It's not only the level. It doesn't mean really where the S&P 500 was at the beginning of the 80s, because a lot has changed since then, and obviously the structure has changed. The companies grow, and they have higher revenues today, so it doesn't make sense to compare the points, but you can compare the metrics. And the PE was at 7.7 back then, and it's around 30 today. So again, a huge difference. So if inflation is relevant for the market as it was in the 70s and beginning of the 80s, then it could have very serious ramifications. But before going there, let's focus on the December reading, which in fact was pretty much in line with market expectations. We had a few months of upward surprises where the markets didn't anticipate this coming, but eventually the analysts from banks, from making forecasts from Bloomberg, Reuters, they adjusted to this process of higher inflation, and this time around at least they were not surprised. However, if you look at the structure of contributions from year to year inflation, from comparing December to November, you can see that this could even be worse. This could be worse if not the fuel prices. As you can see, the oil prices today are the highest since October and 2018. So as you can see, oil prices are really high. They will add to inflation going forward again, and if not this single peak, we would need to revert to as far back as 2014 to see oil prices where they are today. As you can see, in December, which is this period, oil prices were significantly lower because we had Omicron outburst towards the end of November, and then obviously we had market reaction, which was short-lived. So for December inflation reading around the world, pretty much, this commodity contribution was pretty benign, whereas obviously for January, February going forward, it will be probably much more difficult. Also, if you look at the inflation structure in the US, you can see that it's not only fuels. Of course, it's fuels, it's car prices, but the other parts of inflation are rising more and more here. So what it means that actually even as this this one-off factors when they diminish going forward this year, because obviously they will at some point have less impact on the overall inflation, the other parts will add up. So the risk for the Fed is that unless they act, this inflation can be anchored at much higher level than their target of 2%. So the question is, if this happens, how much is it negative for the markets? So first of all, what I prepared for you is the composition of S&P 500 annual returns to inflation and to real growth. Inflation is red kind of bars, and real growth is green bars. So as you can see, we only had, it's again seen here, we only had one situation in the history, post-war history, when inflation was really significant and it contributed significantly to S&P 500 returns. However, as you can see, in many of those years, real growth was actually negative. So inflation from that perspective was very harmful for stocks. However, it was only a single situation. In the period between 69 and 81, consisting of 14 years, the S&P 500 on average lost 4% each year in real terms. So obviously it didn't help. However, like I said, it was only a single situation in the whole period. So we definitely cannot assume that it will exactly be repeated like this. However, we can have more suggestions when we look at the relationship between valuations, inflation, and bond yields. So let's start with valuation versus inflation. As you can see, there is some relationship. It's definitely not linear. It should be something like this, like a banded curve, where you could have justified high valuations with low and stable inflation around the Fed goal of 2%. Today we are at 7%, so we are definitely not here. We should be somewhere here at much lower valuations to be consistent with what happened in a history. Explaining factor why we are here is this, because when you look at this relationship, it's actually much stronger between valuations and bond yields. The higher bond yield, the higher opportunity cost versus equities, and therefore the lower the valuations should be. So today bond yields are very low, therefore valuations are high, and this is consistent. The reality where this is not consistent, this is consistent, must be that this is not consistent again. This is relationship between inflation and bond yields. So again, this is quite strong. The higher the inflation, the higher the bond yield should be, technically looking at the history. However, it's not the case. We are at, despite high inflation, we are at low bond yields. Why, and will this persist? And that's a big question. The Fed tells us we need to act, but the markets doesn't even believe fully in the December projection, even though technically the Fed since then has communicated much more rapid pace of tightening. As you can see, this white line shows that we are not even at the median suggested rate of less than 1% towards the end of the year. So the market even doesn't believe fully in 3 interest rate hikes this year. So you know, we can say that the Fed was expansive for so long that the market doesn't believe it could ever change. However, if it does, and if the Fed starts increasing rates rapidly and it actually continues with delivers on the quantitative tightening as recently suggested, this could have very serious market ramifications. As I said, we still have very low bond yields because there is a lot of money on the market. However, this could change this. The Fed covered treasury issuance more or less over the past 2 years. However, this is going to change going forward. Treasury already issues quite a lot of debt because the ceiling has been pretty much removed, and they need to cover significant federal expenses, whereas the Fed is already printing nearly nothing, and they suggest they could do reverse printing starting probably around July of this year. So of course, going forward, a lot can happen. We could have very optimistic scenario of resolution of production logistic issues, and suddenly we have higher growth, lower inflation. This is a dream scenario which the Fed hoped, or at least that this is what they communicated in the middle of last year, that this is going to happen. We're going to have high growth, low inflation, everyone will be happy. But as we see, this is not what we see. We have Omicron now, we have a lot of technical glitches, and it continues, doesn't seem to be resolving anytime soon. On the other hand, we can have a full-blown economic slowdown where inflation falls as a result of lower demand. But this is not something that we see yet. It's possible, and then the Fed would need to stop their tightening because of the slowdown, which is not certainly a super positive scenario for the market. So the market should definitely hope for the first one. The second one is possible, but it's not so positive. But it's also quite possible that the Fed needs to deliver on the tightening. And if this is the case, we can have a repeat of 2018. And what it means, what it could look like, is best seen here on the S&P 500, where, as you can see, for more than a year, investors are used to the very stable long-term growth. So whenever there is a small dip, it's instantly bought. Even last couple of weeks, nothing seemed to derail this rally. Whenever we had like 3-4% decline, we already had buyers close to this support level, and yeah, the market just continued higher and making new highs. So it looks like whenever it happens, it's going to be okay. So I mean, many people think this, but I think this is only true for as long as with this we have this supporting liquidity situations. If the Fed actually delivers of the liquidity withdrawal, this will be much different. And how it could look like, it's good to return to 2018, where we also had pretty solid fundamental situation. However, the Fed started to their quantitative tightening program and actually provoked 20% market correction on S&P 500, actually slightly more than this on the Nasdaq. So this will be significant, as I said, and at some point those new investors who think that the buy the dip is always the solution could face that the reality has changed. This technically is also important for the euro dollar, where however we had strong downward trend previously. So the situation is a bit different because the dollar was already starting to price in hawkish Fed even before it happened. So now that we have this hawkish Fed, we have actually some attempt to correct the previous downward movement on the euro dollar. And even last week we had the breakout of this flag pattern, but the upper limit of this longer channel, for now at least, they stopped the rebound, and there is still probability that we could continue with this larger downtrend at the end of the day. Finally, it makes sense to look at the gold market because there is technically strong relationship between gold and bond prices, and then bond prices started to decline quite significantly. So technically it should be negative for gold prices, at least in the short term. We haven't seen this yet. However, there's always possibility that it could catch up. Okay, so let's move on and let's focus on this week. So this week there is less of US because we already are in the blackout period before the January Fed meeting. But we have three other developments. We have Bank of Japan tomorrow in the morning in the Asian session, which I only show you because Bank of Japan is interesting from the perspective where they actually stopped any money printing in the second half of 2021. So this is important because if the Fed delivers on their tightening, we could actually have a tough year 2022 from the liquidity situation. So Bank of Japan is not a highlight in the sense that it's very unlikely to provoke big market moves, but it's important for a bigger picture. Now, what is going to perhaps provoke some moves is the data from UK, which is spread throughout the week, starting on tomorrow with the labor market. Then we have CPI on Wednesday, probably most important reading because the inflation in the UK has been accelerating, and it's already caused Bank of England rising interest rates. So the Fed keeps talking about hikes, and Bank of England actually already delivered. And then on Friday we have retail sales data. So if the data is supportive for the story of further increases, this could be seen as a positive for the pound. My focus would be especially on the euro pound currency pair, where it's not this one. This will come here in a second. But my focus would be on the euro pound, where we're exactly at the support level of this very wide and long range. So as you can see, we got there as a result of Brexit referendum, and yeah, ever since the pound has been able to move lower below this support. But maybe here, maybe this time around it's gonna happen. So if the data is supportive, and if we see a story of Bank of England increasing rates more than once, and with the ECB being unable to do so, then perhaps it will lead to a breakout and a larger move lower. So definitely data worth watching. And finally, something that has a potential to move markets if there is surprise is Bank of Turkey on Thursday, because as you can see here, inflation really surged, and because of the politics, we have we saw cuts in rates last year, in the second half of the year, and real rates are lower than -20, which is pretty hard for the currency. It doesn't look good. Of course, looking at the Turkish lira, we see the market come down after a period of huge volatility in the November and December. So we'll see, but definitely, we are no longer at the point where lira is strongly oversold. We are, let's say, in a neutral position. So if we have another surprise from Bank of Turkey, if they cut rates from under political pressure, who knows? We could have more action here. Okay, ladies and gentlemen, that's it from my side for today. Please stay with us, watching our news section, Next Station mobile platforms, where we try to update you with every market developments from Monday to Friday. And I see you on next Monday. So have a great week.